All right, everyone, welcome back to the channel, your number one source for income-oriented investing. I'm joined by Raj from Evolve ETFs. How are you, Raj?
I'm good, Adriana. How are you?
I'm good. I can't complain. Busy, busy as usual. I'm sure for you guys as well, because you just launched a new series, the Ultra Yield series. So, of course, that's going to get my attention right away and my audience attention right away. So, you guys have launched two products, two new ETFs, BIGY and CANY. So, BIGY
Mhm.
focuses on the US market, CANY focuses on the Canadian market, obviously. So, tell me about why you guys decided to launch these.
Well, we came up with great tickers. No, just kidding. Biggie is Big Yield, and Canny is Canadian Yield. I mean, we've had a ton of success in the last couple of years with our covered call funds. I mean, right now as a firm, we just crossed over 8 billion
Oh,
in
congrats.
assets. And thank you. And we were actually, it was perfectly timed with our 8-year anniversary as well. So it was 8 and 8. And over the last couple of years, really one of the major growth engines for us has been our covered call lineup of products. And to be specific, even more so, the growth in our covered call funds that have some modest leverage. I know you've talked about bank a few times on your show, and I know you've talked about Utes, and I think I've been on here before to talk about Utes as well. And so both of those funds have some modest leverage. They have 25% leverage. And we've had a ton of success with them. I think the numbers that I saw last week was that we are now at about 660, 670 million in bank. And I think we were less than half that at the beginning of this year. So a lot of growth. I mean, covered call funds in general in Canada have had a lot of growth as well. I think there's just over 30 billion now in covered call ETFs in the Canadian market. And there's about 10 billion in these modestly levered ETFs as well. So definitely seen significant growth. So when we took a look at, the strategies that we've had that have really resonated, we decided to somewhat rinse and repeat around different areas of the market. And that's how we came up with Biggie as well as Canny. And then, of course, what we decided to do was take on a couple of other little enhancements to it. For example, as I'm sure you're aware, we have a little more leverage in Biggie than we typically have. We have 33% leverage instead of our typical 25% leverage. We have a little more covered or a little more exposure to covered calls. So instead of typically 33%, we go up to about 50% covered. And both of those factors kind of help to generate a higher yield for the fund. And obviously, it's been quite appealing because I think we're not even a month in for Biggie, and it's over. I think it's sitting at around 70 million, and I think Canny is now just over 10 million, maybe even a little bit higher than that. So they've
Yeah.
been amongst our best products from a launch perspective in terms of speed to assets or speed to growth.
Awesome. Yeah, and I want to dig deep further into a couple of points you mentioned. Let's first talk about the leverage. So my first
Mhm.
question, why 33 instead of 25? Obviously, there's going to be higher yield with that, but was back testing done? Why specifically 33, not 25 like bank Utes and oily, for example?
Within our prospectus requirements, we could add a little bit more leverage. We didn't want to get into the world of, double up or double down type of products. We thought to have a little bit of modest leverage made some sense within the advisor systems as well. We thought that 33% would be okay from a risk rating perspective for advisors. So it was kind of a combination. And yes, we always do back testing on all of our products, and we took a look at the portfolio. We took a look at the use of leverage. I'm a big fan of leverage personally because especially in a covered call fund, what it can do is obviously potentially enhance your gains and potentially reduce the amount that you might underperform the underlying basket. So yeah, we landed on 33%. And it's really not that much more than 25, obviously.
Yeah, I'm a big fan as well. All I invest in is leveraged cover call ETFs, as you know. And another good
Yeah.
thing is leverage costs are really cheap. They're really cheap, and I foresee, or my prediction is, they're going to stay cheap for the foreseeable future. So let's talk about stock selection. I'm very curious about that. So you have Biggie, you have 10 stocks. So it's kind of similar to Bank, Utes, and Oily. You guys seem to really like that 10 stock selection. And we'll talk about the cover call strategy in a little bit. First, let's talk about the stock selection. So both Biggie and Canny, you selected 10. So for Biggie, it's pretty much the Mag 7 plus Palantir strategy and Coinbase. So let's talk about that one first.
Sure.
Why 10 stocks? Are you limited to 10? Can you add more? Can you swap names in the future? I'm just curious about that specific number in the stock selection.
Yeah, so first what we decided to do was we started with taking a look at the 25 largest stocks by market cap on the S&P 500.
Okay.
And then from there, we took a look at the stocks that had the potential highest option premiums that we could generate from a yield perspective. And we also wanted to have some crypto exposure. So we really like Coinbase. We really like MicroStrategy or Strategy as well. So we took effectively eight of those 25 largest companies that had the highest option premiums and then added in Strategy as well as Coinbase. That's kind of how we developed the portfolio. Yes, we can have more than 10. If we
Okay.
started to go below 10, then you have concentration limit issues where we would have to go and get an exemption from the regulator. So that's one of the reasons why, as you mentioned, you have Utes and you have Bank. They're all at 10. They typically won't go to 9 or 8 because then you would need an exemption because you'd be more than 10% exposed at any given time of the to the underlying stocks or individual stocks. So it was really a combination of where can we get the best option premiums and also provide some exposure. We're typically going to rebalance on a quarterly basis
Okay.
uh, the fund, but this is an active fund. It doesn't mean that we're going to be making changes every day or every week. We don't plan to. We plan to take somewhat of a patient approach to the underlying stocks. So typically looking at it on a quarterly basis. Yes, it's possible that we might substitute some of those 10 for other stocks. And yes, it's possible that we might eventually increase the number of holdings. I know I've looked on your comment board for some of your shows, and I know that a few people have indicated that they would much prefer it to be a little bit more diversified.
Hmm.
Our experience has been a small basket works quite well. Besides bank and Utes, on the non-covered calls side, we have a tech fund, which is effectively FANGMA or MAGMA. So it's really just six of the tech stocks. We had to obviously go and get an exemption for that because it's a smaller basket, and that fund has performed incredibly well, which is why we look at that kind of philosophy, and it's worked quite well for us.
Awesome. Okay. And what about Canny? So Canny, you have 10 stocks as well. Anything, be honest. I said I'll be honest. I mean, there's competition now, especially in the Canadian space as well.
Yeah.
You have 9 Point, you have Harvest that have launched very, similar stuff as well. A lot of the same stocks, but I've noticed you guys a little bit different with the Canadian selection, a little bit more with the Canadian financials. You have Shopify, you have Chemical, you decided to go with CP, and Brookfield and Thomson Reuters. I thought that was different as well. So, what can you tell me about the stock selection for a Canny?
It's actually a little bit simpler than you might think,
Hmm.
and a little bit simpler than Biggie as well. We really just took the 10 largest stocks or by market cap on the TSX 60
Oh, okay.
but we didn't want to own Brookfield twice within the portfolio because you have Brookfield Asset Management and Brookfield Corp. So we substituted one of them with Cameco, which is a uranium company. So that's kind of it. So it really is effectively the biggest companies by market cap in the Canadian market today. So yeah, by default, you do end up with, some of the banks and some of the utilities and pipelines and so on. But it's a pretty simple strategy in terms of the portfolio selection.
Yeah, it's like the TSX 10, kind of, you could say.
Basically, with one exception of the Brookfield
The-
swapped out for Cameco. But yeah, it's basically the TSX 10 with a covered call overlay and some leverage.
Okay, and before we discuss my favorite part, the cover call strategy, I noticed that you guys are doing semi monthly distributions or two distributions a month instead of monthly. Why did you decide to do that?
Yeah,
Is it,
I think first of all, it's important to clarify the difference between semi-monthly and bi-weekly. So bi-weekly, well, if you simply do the math, there's 52 weeks in the year, right?
yeah,
So bi-weekly would mean that you end up with 26 distributions in the year. Bi-monthly or semi-monthly, as you said, is twice per month, which means that there's 12 months in the year, so you get 24 payments. So there's 24 instead of 26. There's a little bit of a nuance, not a big difference, but a little bit of a nuanced difference between semi-monthly and bi-weekly. So to be clear, we are semi-monthly, so there's 24 distributions on a annual basis. When we talk to a lot of individuals out there, they really like the concept of more frequency of their distributions, a little bit like the way most people get paid. Most people
yeah.
get paid, semi-monthly. They get paid on the 15th and 30th of every month and so on, or the 1st and 15th of every month. So we kind of like that tied to it. And we've seen in the US, some of the funds have moved to even weekly
Yeah.
distributions and they've really resonated with investors. So we decided to go as far as we could because unfortunately the infrastructure in Canada is still not there to allow weekly distributions. So we went as far as we could, which is obviously semi-monthly.
Makes sense. Yeah, I mean, weekly is very popular in the US. Just today, Yield Max announced they're going weekly for everything. So I don't know if you saw that, but yeah, pretty crazy. And now that there's even some providers that are doing twice a week. So yeah, and it's
Yeah. I mean, we're getting the daily, right?
yeah, I think daily's coming too, or they're trying to do it
Yeah.
in the US.
Yeah.
It's
Yeah.
crazy. But yeah, thanks for the
I mean, if
the
investors,
difference.
if investors are, if that's what investors want, then, we as the issuers need to figure out whether we can do it. We
Mhm.
have the systems and operational capability to do it and the regulatory capability to do it. And if we do, then we should be giving investors what they want.
Awesome. Like hearing that. And by the way, in case my audience didn't know or didn't check, it's the management fee on both Canny and Big Ear is 40 basis points. So pretty low management fee considering typical relative to cover call ETFs in Canada. Let's talk about the cover call strategy. You talked a little bit about it, up to 50%. That we're talking about portfolio coverage, right? So let's stick on portfolio coverage. Are you writing at 50%? Can you go more? Can you go less? I know you guys have an actively managed approach. Tell me all about the covered call strategy when it comes to portfolio coverage, if you please.
Yeah, and I think we've talked about this on previous shows, Adriano.
Yeah.
It's kind of like a whole bunch of parts that you need to put together. You need to figure out there's multiple variables, right? How much do you want to have covered versus how much market exposure do you want to give the investor? How far out of the money do you want to write the calls or do you want to write at the money? All of those things kind of go into how liquid is the options market. Do you want to roll monthly or do you want to roll less frequently? All of those kinds of things go into our approach. And I think I've mentioned before, our covered call strategy is run by Steve Pate. We have an entire team surrounding him as well. Steve and I worked at Fiera before. Fiera is one of Canada's largest asset managers, and I'm sure I've told this story on a previous show when Steve and I worked at Fiera together. He was one of the only people that I'd ever met that was able to consistently make money for investors trading options. So when I set up Evolve, he was one of the first hires that we made because he's that good. And so from day one, virtually day one, I think maybe 1 or 2 months into our inception of our funds, we decided to launch covered call funds. And then, of course, we've been doing it since then. I think we're now running just over 2.5 billion, probably closing in on 3 billion just in covered call funds within our $8 billion firm wide. And so, for a lot of our funds, when we started, we were 33% covered.
Hmm.
We were writing 3 to 5% out of the money. We were rolling on a monthly basis. We've tweaked that a little bit here and there where we've either dialed up the amount that we're writing calls on, or we're writing slightly less out of the money. Instead of maybe 3 to 5% out of the money, maybe we're writing, 1 to 3% out of the money. For these funds, we are very close to at the money that we're writing. So we're very much focused on the yield component
Hmm.
for investors. They need to feel comfortable that this fund is paying enough yield, but we also want to give them some upside exposure. And so you're typically giving them, 50%. So if we're writing on 50% at the money, that means that we're giving you 50% of upside and downside exposure to the underlying basket. With Biggie, so that's for Biggie and Canny.
Yeah.
We're writing at the money at 50%. We do have the ability, just to be clear, we do have the ability within our prospectus to write on more, but that is not our intention. Our intention is always to kind of keep it around 50%,
Okay.
because we want investors to have the equity market participation along the way. It shouldn't just be about yield, because if it was just about yield, then you'd be writing on 100%. You'd have no, or 90 something percent. You wouldn't have really any upside potential in the equity markets. But remember, when you also add 33% leverage, you're also giving the investor more market participation
Right.
along the way as well. So if you think about it from a mathematical perspective, if you invested $100 and you have 33% leverage, that means that you would have $133 invested. But if you're writing on 50% of the portfolio, let's say at the money, that means that effectively 67% of your investment is tied to your yield component, but then the other 67% is tied to your equity exposure. So this is really one of the advantages, I guess, of leverage. But again, the advantage can be a disadvantage too, because if you're in a downward trending market, that means that leverage is obviously going to compound your losses as well. So it's important to kind of understand the numbers that go into it. Whereas normally, if we don't have leverage and we're writing on 50% of the portfolio, that means you only have 50%
50%.
exposure
Yeah.
to the market. In this case, when you have the leverage, you're actually getting closer to 67%. What does that do? Well, that hopefully helps your participation rate in the equity markets, which means that if you're moving up over time, you could potentially outperform your underlying basket, but you obviously need a market that's going to actually support that. With Biggie, we are not just writing weekly options, but we're also writing monthly options as well. And monthly is the norm. There are no weekly options available in the Canadian market. So with Canny, we're just writing monthly options. But in both cases, typically at the money on 50% of the portfolio.
Awesome. I don't think you could be any more clear than that. That answers all the questions about the strategy. And that was my assumption, approximately at the money on 50% to achieve those high yields. And the math is pretty simple, right? If you're covering or if you're giving up half the portfolio and there's 33% leverage, well, you do 133 divided by 2, which is about
You
67.
got it.
So Raj, that's all the questions I have. I think it's pretty clear what the objectives are for this new Ultra Yield series. You have Biggie for US, Canny for Canada. I know you can't talk about future products, of course, but I always have to ask this question. Any plans for future ETFs in this Ultra Yield? Maybe something related to crypto, maybe? I know that, I don't know if you've seen Purpose is adding 33% leverage to
Yeah.
their Bitcoin and Ether cover call ETFs. What can you say, if anything, about that?
Yeah, I mean, I don't typically talk about our product pipeline, but I would say to you, our intentions are definitely to grow out the UltraYield lineup of our products. That these two funds, Biggie and Canny, are the first within our UltraYield lineup. So we created this category with a purpose that there wasn't going to just be two funds in the category. We're obviously planning to bring out more, and I will leave it at that.
Sounds good. That's good enough for me. So, Raj, thanks so much for taking the time. Really appreciate it and hope to have you back on the channel again in the future. Take care.
Thanks, Adriana. Thanks, everyone.